Have you ever wondered how a huge company, or heck, even your local coffee shop, actually knows if it's making money or not? It's not just about what's in the cash register, it's about telling a complete financial story. And today, we're going to learn the language that tells that story: accounting. Let's jump right in. I mean, it seems like a simple enough question, right? You've got money coming in from sales, money going out for bills, but at the end of the year, how does anyone really know if they're in a good spot? How does an investor decide where to put their cash? This is the big problem that absolutely needs a clear, reliable answer. And the answer, believe it or not, is a language. A structured, universal language that every single business, from the corner store to a global corporation, has to speak. It's called accounting, and its whole job is to take all that financial noise and turn it into a clear, understandable story. So, how are we going to learn this new language? Well, here's the game plan. First, we'll talk about why it exists. Then, we'll get into the core vocabulary, the keywords you gotta know. After that, the rules of the game, the grammar. Then, we'll see how it all comes together to tell a story. And finally, we'll look at why knowing this stuff is so important.
Okay, first up, the language of business. Before we get into all the nuts and bolts, let's just take a second to understand the why. Why was this language even invented in the first place? Well, it all boils down to one thing: making better decisions.
The American Institute of Certified Public Accountants has this great definition. It sounds a little formal, I know, but look at that first word: art. It's not just math. It's the art of taking all the financial chaos of a business, every single sale, every bill paid, and organizing it so that we can actually step back and understand what it all means. All right, you can't learn a language without knowing the words. So in accounting, there are a few key terms that are the absolute foundation. Let's break down the three big ones you'll see everywhere. First up, we've got assets. It's a simple idea, really. Assets are all the valuable things a business owns or controls that will help it make money in the future. So for our coffee shop, the assets are things like the cash in the till, the building they own, and of course, that big, shiny espresso machine. Next up, liabilities. This is the other side of the coin. It's what the business owes to other people. Think of it as someone else's claim on your stuff. For that coffee shop, a really common liability would be the bank loan they took out to buy that fancy espresso machine in the first place. And finally, there's equity. This is the part that really matters to the owner. After you take everything the business owns, its assets, and subtract everything it owes, its liabilities, what's left over is the owner's true stake in the company. It's their piece of the pie. And here's the magic. These three words, assets, liabilities, and equity, they all lock together in this one simple and perfectly balanced formula, the accounting equation. The value of everything you own is equal to the value of what you owe to others, plus the value of what you truly own yourself. Let's go back to that espresso machine. Say it's a $10,000 asset. If you got a $7,000 loan for it, that's a liability, then the remaining $3,000 is the owner's equity. See, it always balances. This little equation is the foundation for everything else. So, we've got our vocabulary, but for a language to work, it needs rules, right? A grammar that everyone agrees on. Otherwise, it's just chaos. In accounting, these rules are called principles, and they're what make the whole system trustworthy. These principles, often called GAAP, or Generally Accepted Accounting Principles, are basically the official rule book. They make sure that when one company reports its profits, it's doing it the same way as another, which creates trust for everyone involved. Let's look at a couple of the most important rules. First is the accrual concept, and this one is a real game changer. It says you record business activity when it happens, not necessarily when cash changes hands. So if our coffee shop caters a big event in December but doesn't get paid until January, that sale still counts for December. Why? Because that's when they did the work and earned the money. It gives a way more accurate picture of how the business is actually performing. Next is the going concern concept. This is basically the let's assume we're not going out of business tomorrow rule. It's an optimistic but really practical idea. It means we can value that espresso machine based on the years of coffee it's going to make, not what we could get for it if we had a fire sale tomorrow. It lets businesses plan for the long term. And finally, we have consistency. This one's pretty straightforward. You can't just change the rules halfway through the game. A business has to use the same accounting methods from one year to the next. This is super important because it means you can compare this year's performance to last year's and know you're actually comparing apples to apples. Okay, so we've got the words and we've got the grammar. Now for the fun part. Let's see how a single simple event, like you buying a cup of coffee, is woven into the big, grand financial story of the whole company. This is the accounting process in action. Whoa, okay. I know this looks a little complicated, but don't worry about the details. Just think of this as the roadmap. It's the journey that every single financial event takes, from a raw piece of data to a polished, meaningful report. Let's just hit the main stops along this road. It all kicks off when a transaction happens. A sale is made. That sale gets recorded in a journal, which is kind of like a daily diary of everything that happened. Then, those entries get sorted into a ledger, which is more like a big library with a separate book for every single account. We then run a trial balance just to double-check that our main equation is still in balance. After a few little tweaks and adjustments, it all comes together in the grand finale, the financial statements. That's the published story everyone gets to read. So we've learned the words, the rules, and the process. Let's bring it all home. Why should you care? Why is learning this language actually so powerful? Well, it empowers just about everyone. The company's own management uses these reports to plan for the future. Investors read them to figure out if a company is worth their money. Banks look at them to decide if a business can pay back a loan. And yeah, the government uses them to make sure everyone's paying their fair share of taxes. It's really the foundation of trust in the whole economy. But, it's not perfect. Like any language, it can't tell you the whole story. Accounting is amazing with numbers, but it has no way to measure things like great company culture or happy employees. It values things based on what they cost years ago, not what they're worth today. And sometimes it relies on human estimates, which can have some bias. It's an incredibly powerful tool, but you've got to know its limits. But at the end of the day, that's what accounting is all about. It's a system designed to take the messy, complicated reality of doing business and boil it down into a clear, standardized story. A story that gives us the power to understand where we've been and, more importantly, to shape where we're going. Look, we've only just scratched the surface of the vocabulary and grammar today, but it's a huge start, and it really leaves you with one last question to think about. This language doesn't just apply to big companies. It applies to your own life, too. Now that you know the basics, what story do your finances tell?